We have with us Andrew Popper, Chief Investment Officer at SG Hambros Bank. Welcome. Thanks for coming to talk to us today.
Sure, good
if I could start by talking to you about what we've seen overnight in Asia. We hear that China's slowing, but then a few weeks ago we were concerned that China was overheating and creating asset bubbles. What really is going on here?
Well, of course, there is concern about China because with the world economy coming out of the recession, China was seen to a large extent as the engine for growth. At the same time, however, they had to deal with all the aspects related to the currency. They maintain an artificially low currency that allowed them, of course, to continue to export, also build reserves, but created problems on the domestic side in terms of inflation. Being forced by international pressures to allow the currency to move freely and, in effect, to appreciate, there will be a slight deflationary effect on the Chinese economy. It will slow down economic growth. And, of course, we're seeing now, today, the concern over the possibility of slowdown in growth in the economy and quite a significant negative adjustment in the Chinese stock markets today.
But should we be concerned about it? I mean, is it real or is it just apparent because of the appreciation of the yuan?
No, of course it is real. It is real, but I'm not sure to what extent it is disturbing because China will still continue to grow at a solid pace. The other countries in the world economy are also recovering. So I'm not sure it will have a major negative impact on global growth, but it is real that is slowing down compared to their previous track record in terms of economic growth.
Now, we've had the G20, and really it didn't seem to move markets much at all. Do you think we got anything very solid out of the G20, or was it a bit of a fudge and a compromise?
Well, I think that what came out of G20, which is generally positive, is that there was some degree of consensus of fiscal consolidation. And there was agreement, if you will, to disagree in the sense that they agreed that different countries face different economic conditions and they should be tolerant to each other in terms of what they want to do in terms of fiscal policy. But the big story that dominated G20 and G8, and it's in fact the major story of the stock markets in general, is the fact that the consensus that existed in 2008 about having to have aggressive fiscal policies and aggressive monetary policy, that consensus doesn't exist anymore because the economy is recovering and the markets are concerned over the level of government debt. So now we have divergence, inevitable divergence in fiscal policies. Countries are being forced to embark on more restrictive fiscal policies, and there is inevitably concern or whether that will undermine economic growth and it will lead to the infamous double dip.
Indeed. And what is your take on that? Do you think that these austerity programs will cause a double dip?
I don't think so. I think that legitimately there are comparisons drawn with the policies, economic policies, which were ill-fated in the wake of the Great Depression. But it is quite different now. People are not really trying to balance budgets. What they are trying to do is to reduce the deficit, which is enormous. It is definitely, we are facing the highest deficits in peacetime. There's concern in the bond market about financing the deficit, about the monetization of the deficit by the central banks. So people are not trying to eliminate the deficits and balance the budgets. They are not trying to tighten monetary policies. They are just trying to adjust on a relatively modest scale fiscal spending. So I don't think it will lead to a double dip.
And what about the new information we have over Europe's decisions to stress test banks and the fact that sovereign debt will be included in that?
Well, it very much depends on what the stress test is going to show. But the idea of transparency and the idea of telling the markets what is real is probably better because people have a tendency to suspect the worst if they are not told the truth. But, of course, there will be concern about the exposure, especially to Greek debt and other sovereign debt, which is questionable. And some of the banks will definitely come under scrutiny by the financial markets. But in general, the idea of being truthful with the market, being transparent with the market is a good one.
Okay. Andrew Popper from SG Hambros Bank, thank you very much indeed for joining us today.
You.